All right, everybody, welcome back to Matt Money. Today I want to talk about Exxon. It's a pretty crazy one. I recently just sold about 350 shares or so in the mid 80s, so technically I'm a little bit down, but I put that money into the S&P 500, so I feel more comfortable in the next 20, 30 years with the S&P 500 versus, say, Exxon. I just think that there's a lot of transition going on in the oil and gas, so I had made about 100% return on my Exxon shares, so I'm not too upset by letting them go. I wish I'd sold them at this peak here, but sometimes you get stuck in meetings, man, and it dropped so quickly that day. I think it dropped like 8 or 10% or something like that in a day. And by that time, it was mid 90s, and I was waiting for it to go back up. Eventually, everything was kind of pulling back over the past month, month and a half before this recent run up over the last 10 days or so. And so I just took the opportunity to move it into the S&P 500. I think I bought half in the S&P and then half in Shell. So I'm not completely out of oil and gas, but my allocation was just getting too large. But what I really want to talk about specifically is Guyana. So one of the big reasons why I invested in Exxon is for that reason, was for Guyana. And, it's done really well, as you've probably have seen over the past year of returns. It's kind of up slightly since 2020. So overall, doing pretty good. Can't complain with it. But the long term, I don't really vision it going up 2 to 3x from where it is today, unless they have a significant change in their operating structure. And to be honest, the only way that I see them having a way to do that is through Guyana and through the Permian. Their two biggest investments to date, and they just announced another two discoveries rather recently. Now, for those of you guys that don't know much about what's going on in Guyana, in 2015 they started drilling in Guyana offshore, where not a lot of people had drilled anything, and they found oil. They found a discovery, and since then they've drilled about 20 wells, of which 90 or 95% have been successful, and they've already sanctioned 3 FPSOs, floating production storage offloading facilities, and they are about to bring in a fourth, which I think is supposed to FID and come online by like 2025 or so. So I think with the resources to date, they have about 11 billion barrels of recoverable oil discovered to date, and they are not stopping anytime soon. And that at the moment is the ability to put, I think, 10 or 11 FPSOs from what they found so far. So I just want to walk through it a little bit. Great article here on Seeking Alpha. If you're interested in joining Seeking Alpha Premium, there's a link in the description. And also, for those of you that are looking for a WhatsApp group to chat with me, Bailey, Bailey, Cole, a few others, Cashflow Kyle, all those guys, there's going to be a link in the description for that as well. So more than happy to help you guys in any sort of journey. It's free, no, not looking for any capital or anything from you guys, just trying to help you guys in your investing journey. So back to Exxon. Guyana partnership will steadily increase significance to Exxon Mobil's production. Agreed. And also, this is, I think, the majority of oil, to me, over the next 10 to 20 years will come from South America, offshore South America, in places like Uruguay. Suriname's going to continue. French Guyana is going to continue to do well. Brazil is in its infancy as well. So I think you're going to continue to see these establishments. You have great river systems coming off of South American continent and have yet to truly be explored. And so with that, I think the continued development on offshore Colombia as well. But I've only really seen offshore Colombian gas, not so much oil as of yet, but I haven't done much research. So, into the Seeking article alpha itself. So thank you, Long Player, author of Oil and Gas Value Research, for creating this. Neighboring Suriname as well, at a deeper depth in Guyana. Suriname is doing really well, being explored by Apache and Total right now. So just want to hop right into it. So investors, company found such a project off the coast of Guyana. Since the project is in the early stages of generating cash flow, incremental results are not yet significant on an annual basis, but the project cash flow is getting larger, so that will change in the future. This is currently owned in part ownership with Hess as well. I think Exxon owns 45% of it. Hess owns about 30% of it, and the rest is owned by, I think, some Chinese company. I forget which one. Hess discovery was around 18,000 foot depth, where a lot of the other discoveries were around 15,000. So it's a different geological formation, which could open up further exploration opportunities at a different depth, right? So a lot of people, especially what I deal with in the Gulf of Mexico, everyone tries to develop a play at once. So once a play kind of gets discovered, it opens up the opportunity for other people to look at the same depth, right? So you know that there's sand there that's been deposited across a multitude of different structures that happen across different depths in time. And so with that, you know that, hey, this has oil. It's likely that this has oil too, right? So the partners are hopeful that this interval will likely contain billions of barrels of oil as well, explored shallower zone. Should that be the case, a project with considerable upside on a geographic basis, meaning the production area will continue to expand from what is now known, and operators can drill deeper wells that are cost competitive to produce more wells. The result of this is that the growth horizon for the project is now extended beyond the years of the long-range view of most companies. So what they're saying is, hey, we have this established investments so far. Liza Phase 1, Liza Phase 2, Payara, which are already kind of like almost in the ground. These of two has already started up. This third one here is about to start up, and I think that they're going to sanction this bad boy, if they haven't already, in the next, I guess, few months. Maybe they already have. But what this is saying is basically like, hey, these were all 15,000 foot sort of horizon depth. If you have the opportunity to drill deeper and to get 3,000 feet deeper in this different geologic formation, these have an extended ability to develop more. So instead of investing all this capital into creating more and more boats, you can create less boats and kind of drill deeper and develop that infrastructure, and it lowers the amount of initial cost of the initial break-evens, right? So you have $35 break-even initially for all the initial investments that you've done since Liza Phase 1. If you're able to bring on more projects, you don't have to bring on another big boat, which costs billions of dollars to bring out. You just have to invest in the wells themselves. And so the break-even of Liza Phase 1 or the Destiny facility will continue to go down because they're bringing on cheaper and cheaper oil that you don't have to invest billions of dollars into. Now, they may invest billions of dollars, but it might be going directly into the wells versus the boats and facilities that are out there. So Mr. Hess has projected that this project should allow production to increase 10% annually for the foreseeable future. Initial production increases will be lumpy until a reasonable sized production base is established. Since Hess is a smaller company, production growth will be much more significant for Hess. Obviously makes sense. Hess is like a $35 billion company. But a project the size of this will also become significant significant size for the company of Exxon, which I agree. If you're able to have these great low cost break evens, and you're also continue to develop the different horizons beneath it, then it's going to drag these down into the low 30s or even the low 20s. And that's going to be great for the cash flow statement of Exxon as well. They'd be able to divest, say, higher break-even cost barrels and invest it into things like this. Partnership already allowing 2 FPSOs producing, which is Destiny and Unity. And the second of those is ramped up production point, where partners have been reviewing add-on projects, kind of like we were discussing, to increase production capability. The ability rises to the profitability of the initial production projects higher. The real question is if these more cheap projects are available for the production platforms. The places this partnership is well ahead of in Guyana in terms of cash flow production. The market has not yet come close to responding to the discoveries in Guyana, but the beginning of cash flow should change the picture for a smaller company like Hess. It also has the beginning to affect the market perception of a company like Exxon Mobil. At the moment, they have the ability to underpin 10 FPSOs. Those ships are not cheap. Cost of the project requires a lot of capital and reserves to justify upfront to install an FPSO. But the current price of oil and gas is extremely important for the partnership. But basically, just breaking it down, which I think they do a really good job here, at a production rate of 200,000 barrels a day, which is rough, but these 2 or 3 previous boats are over 200,000 barrels a day. So to justify those for a full year's worth of production, where's this? That currently sells for about $20 million a day. 200,000 barrels, $20 million a day, not including the natural gas or other production from liquids or something of the like. That rate is about $6 billion per year for the partnership, which means the cost of an FPSO is roughly covered within 1 year's worth of revenues. Now, of course, you have lifting costs, you have the fact that you have to pay employees, you have the fact that you have to continue to have operating expenditures, chemicals, all those things. So all that $6 billion isn't there. But if you're able to walk away with $3 billion, it takes 2 years to build back, and you're still going to have a production stream for the next 8 to 10 years. Looks pretty good, right? So Mr. Hess estimates that the Hess share of the cash flow is about $1 billion a year for each FPSO. So the cash flow, meaning this is after expenses were paid and everything the like. So out of that $6 billion, expenses get paid through Exxon and everything like that being the operator. And Hess's share of what's actually left over is $1 billion a year per FPSO, except for the first one at the current prices, because the first one's 120,000 barrels a day capacity versus the 200,000 barrels per day. That is the Hess share of the cash flow. Exxon Mobil has a much larger percentage, so it has a larger benefit. As more FPOs begin to produce, pace of exploration and development is likely to increase. In my opinion, they should probably put back 15% of whatever they produce in cash flow back into the ground to see and have as exploration budget. And the rest, 85%, they can use for just regular buybacks or dividends or investing in renewables or CCUS or whatever they want. Public discussion used $90 for the price of oil next year. Next year is an extremely long time in an industry like this one with very low visibility. Understood. Anyway, now the Yellowtail project is estimated to come online in 2025, has the highest project cost at the moment, about $10 billion. However, the current price environment makes that very profitable project. Mr. Hess talked about a sticker shock price of this FPO project that may come at some point in the future, make another FPSO a non-starter until prices improve. But for the time being, in the low break-even price of any of these projects, it's impressive enough to make that a remote possibility. Bottom line is not needing to add additional cash or needing to add less cash when production first begins raises the overall profitability of the project. Significantly, because there is cash received sooner, has a far larger influence on calculations, right, return on investment and everything. So that means they don't have to go into their pockets because you have these things that are so low break-even, generating more and more cash flow. You have two online right now. Those two, instead of, say, going back to the business and the group, they can use it within region. So let's just say Guyana, with the two FPOs they have $1 billion worth of cash flow coming in. If you're able to continue to invest, say, half of that back into everything, the value of those are going to continue to come online over the next 5 to 6 years. You're going to end up having another 6 or 7 FPSOs starting up. By 2030, I think their plan is to have 7 FPSOs floating out there producing cash. So to Hess, that's $7 billion a year. To me, I don't know why the hell somebody hasn't bought Hess yet, but that's just another story for a different day. The partnership has been increasing activity lately in response to the higher oil price. This is the summary. That has resulted in an increased pace of discoveries. Exxon just announced 2 more discoveries, bringing the discovery total to the highest number ever for the partnership. There will likely be more added in the future because this year is not yet close to done. So check this out. All these different exploration targets that they've already discovered throughout here. And if you look, here's the Unity, I think. Discovered barrels to date. Do I have a scroller in here? No. So let me just get out of here. You can see initially, 2016, they had about 1 billion. And it's just continued to increase at the pace of like $1 billion, $1.5 billion every single year. They're about 11 billion at the moment. You can kind of see what their capacity looks like. This isn't a production profile, but it's capacity. And with this Yellowtail, I mean, they're anticipating to get up to 750,000 barrels of oil a day. And that's not even inclusive of a 5th or 6th FPSO. So by the mid-2026 timeframe, they're going to be producing a crap ton, man. At the moment, they're already producing 300,000 barrels a day, pretty easy. And you could kind of look, ramp up for key deepwater areas where things have kind of come in. In year 1, this is kind of the production profile since startup, right? So this year 1 is 2019. Here we are kind of in year 4, and you're kind of at this 400 to 500,000 barrel a day range. And in 2 more years, you're going to have 2 FPSOs online, and you're looking pretty good. So, yeah, an additional 6 or at least 6 FPSOs by 2027, and they're not done discovering, right? It's pretty admirable kind of what has been happening in Guyana, and I don't think people have realized the magnitude of it. It's going to be pretty significant. And this is just on Hess's and Exxon's ownership. This isn't inclusive of other discoveries on other fault blocks. Other lease blocks. The recoverable resource has been trending upward for some time. Shareholders for the importance of the beginning of production is shown in the lower right of the slide. Production is increasing at the time of demand imbalance. The timing of the production expansion could not be better. More to the point, investors can already see more than 300,000 barrels a day of production for another FPSO to be scheduled to begin production in 2023. Even for a company the size of King Exxon Mobil, as more than 500,000 barrels a day of low break-even production is significant in 2023. The projected 6 FPSOs shown are likely to generate at least 1.5 million barrels of oil a day. At that point, the production growth for Exxon is likely to move into a pace rarely seen for any company, not just a company of Exxon size, but just any company. And this kind of just shows the earnings capacity that you have from 2Q 2022 to expected year to date. And this is the operating results. And you can just see that it's just massive. 16 billion year over year in terms of ops cash. And a lot of that, I'm sure, has to come from Guyana, but a lot of it's just price in general for Exxon, right? So, including the company is reporting previously unexpected levels of cash flow and earnings. A lot of that comes from margins, as well as just high refining margins as well. Allows the initial Guyana investment they were making during these times of offshore low prices to pay back very quickly. Initial assets of the partnership pay back in a very large way. Current effect of high prices on long-term projects like building FPSOs is muted because the infrastructure takes years. A partnership does not want to be caught in an industry downturn with big bills and many expansion projects. Production promises production growth that will be significant to Exxon for the long term. So I just thought this was prudent to kind of bring to your guys' attention. Honestly, I'll say it again. I don't know why Hess hasn't been bought. $35 billion company. If we just want to look at it real quick. Sorry, I was looking at Ethereum Classic. $112 a share. And last I checked, it was a $35 billion company. Yep. So I don't get it. I don't. You could buy it. Yes, you're going to have to add capital. But if you're knowing that you're going to be generating approximately $6 to $7 billion in ops cash in 2025, I get it. But you're paying $6 now to get like a dollar. You're paying $6 now to get $1 of cash flow in the future. And that's not just for 1 year. That's for like long term, plus the upside opportunities, plus the infill opportunities. 11 billion barrels of recoverable resources, of which, Hess's option of that is, and that's recoverable resources, right? That's not contingent resources or things that haven't been kind of discovered yet. And like those are proven barrels that they are announcing to the market will be recovered. And yes, they can go up 10%, down 20% or whatever, but the magnitude is there. 11 billion barrels. Are they actually going to recover 9? Or are they really going to recover 13? It's early, right? Who knows what's actually going to happen? But at the end of the day, you have to recognize what reserves mean versus like potential. So we're talking reserves, meaning there's a high likelihood, 90% likelihood that they'll be produced. So 11 billion barrels are kind of on the books, right? That's what they're stating is on the books. Hess's share, 3.5 billion of that, if not more. And they're still drilling several wells a year for exploration purposes. So it just goes to show you like the longevity of what's going on right now, coupled with the movement into Suriname and stuff of the like. I don't know why Apache and Hess have not been bought out yet. Apache being another piece. Like I should probably do something on Apache because it's just interesting to see what's kind of going on with them in Suriname. And it's kind of been quiet. Like they've had 2 pretty big discoveries at this point. Have they sanctioned a project? I don't think so. I think they might at the end of this year. And I think Total might have done something in recent months, but I need to check. So anyway, I wanted to bring this to everyone's attention, share it with you guys, and I just think it's interesting. So pretty cool. And if I see a dip in oil prices, and that means Exxon dips, then I'd be more than happy to probably pick up more and ride it back up because of the cyclical nature of the business. But yeah, I just thought it was a good exit point right now. While oil prices are high, I think oil price will continue to come down. I think natural gas I'm very long on. So yeah, in the event of a downturn, I'll probably be looking for LNG export facilities and stuff of the like to grab on an opportunity for a swing trade back up. But it just didn't make sense for me to have so much energy in my portfolio at such high prices when honestly, I think within the next few months or few quarters, demand is going to go down pretty good. And with that, you're going to see a decrease in demand for the products themselves. And when demand goes down, oil price goes down. So anyway, I hope you guys are having a good one, and let me know if you guys are interested in joining the WhatsApp group, and hopefully I'll see you guys in the next one. All right, have a good one. Cheers. Meow.